Hi everyone, and welcome to our webinar tonight. I'm Alyssa, I'm your host, and in a moment I'm going to be welcoming Sam Khalil, DPN's Managing Director. We're going to talk about why 2020 is the right time to invest in property. Now that's a bold statement, and I'm keen to explore this topic with you tonight. And over the next 30 minutes, we're going to hear a market update from Sam Khalil, and we'll endeavour to answer your questions too. Now, many of you have sent in your questions already, but it's not too late, and I'll show you how you can ask a question in just a moment. Now, but first, who is this session for? So this session is relevant to you if you are actively wanting to invest in property and looking how to navigate the current climate, or even if you're not yet actively looking, but you just want to gain some further insight. This is going to be a jam-packed session tonight, and we know you're going to find it really useful. So look, it's a 30-minute format and it is an interactive webinar as well. So if you haven't joined one of these before, there is a chat function and I'll just show you how to use that. So if you can hover over your phone or your laptop or computer, you will see a chat button. So just to check that's working, jump in and say hello, maybe where you're from as well. And a huge shout out to all of you there, and thank you for joining us tonight. Now, if you have a question during our session tonight, you can use the Q&A button. So settle in, get comfortable, and let's get started. Welcome, Sam.
Hi, Alyssa. Great to be with you tonight, and thank you to everyone who's joined us.
Thanks, Sam. Now, look, Sam, in the midst of a crisis or a pandemic, in this case, there's often some inspiring words that are to give us some hope or perspective. And here's a quote of inspiration from Albert Einstein. If you can't see your screen, it says, "In the midst of every crisis lies great opportunity." And now this might be inspiring, but is it relevant to the property market? There's been media articles suggesting the property market will fall as much as 30%. At the same time, there's been articles that property is set to surge to boom levels, and it's causing some confusion for our audience. So Sam, perhaps you can start by sharing some insight on what the property market is doing right now.
Thanks, Alyssa. I've been in this industry for about 24 years now, and that is one topic that is always discussed every year, every season, regardless of when, whatever cycle we're in, whether it's a property cycle or something happening in society, on the world stage, and people are always asking what the property market is doing and where it's going. And I've always had pretty much the very same answer, and that is there is no actual one property market in Australia. The fact is there are at least 8,800 suburbs in Australia, and they're growing. There are more suburbs being created. And what we see in the media and often written about in articles is generally a number of things. Number one, it can be just the average, a discussion of the average of all the properties in Australia, or it could be sometimes sensationalist media. You know, at the moment, media is trying to get as much interest in articles as possible, so you won't have things that are clickbait, and so you'll have some sensationalist articles, something like property market sees 50% fall, but in the small print, in transactions. So all that's saying is that the amount of transactions fallen, but not the prices have fallen. Or you might see an article that says CBA predicts 30% fall in property values. Now this is one of, I think, 3 scenarios they did, and it was the most severe scenario modeled out. And it shows a possible scenario, not an actual or what they may predict. And they were just modeling. It's a spreadsheet. But my question is, does that mean every property in Australia will fall by 30% at the exact same time, where just someone somehow creates a value on all those properties? And your house drops to 30%, your neighbour's house. That's just not realistic. It just doesn't happen that way. And the question then is, does it stay depressed? It may happen for a flash moment, or it may be based on one sale or a few sales that cause duress. Now, are there times in history and in nations where there has been considerable pops and the general market overall has been depressed? Yeah. But interestingly, in Australian history, in the property market in Australia on the average scale, I'm not talking averages, there has never been a crash at the median house price. Just has never been. Not like the share market or anything like that. We have never seen, when I say a crash, at least a 30% drop overall in house price. It's been predicted for years. It's been talked about for years. So it's not impossible. It's just probably more improbable. And the reason behind that is that, as we can see what the government has done and what the banks have done, is they have staved off massive price reductions because you otherwise will get systemic risk and the whole of society will be punished even more. And there's a price to pay for that, but the price is greater if they didn't address it or arrest it in some way. And that's what they've done. Things like the JobKeeper package, the bank holidays and payments. There's no interest for the banks to have a massive write down on asset values when they're holding the loans, because it will be massive harm to them as well. And then no one will win. So what we can see is the government understanding that acting sooner and in a very strong and powerful way has ensured we don't have this massive cliff and falling over. And so I would say to you that there's the only reason that you would see a significant drop in prices is the basic and first law of economics, which is supply and demand. And that's where there is massive amounts of property.
So Sam, just to interrupt there, with interstate travel restrictions and talk of immigration slowing, I'm interested, what are the prospects for growth looking like? And maybe you can just, talk a little bit about the supply and demand side.
Sure. Okay. So I'll come to that just in 1 second. I'll just finish on this point, Alyssa, is that the market activity did fall off a cliff. So a lot of people pulled their homes. So what we see here in this market at the moment is actually a lack of supply. Now that's coming back on. And what we've seen right now is not a tale of two cities, but 1,000 suburbs. And we're seeing very mixed results. So Cronulla, where our office is, we've just seen a record price of 10.25 million in the peak of the crisis. Auctions last weekend in activity, we've seen, prices are well and hundreds of thousands of dollars above reserve in Sydney and Melbourne. Yet in other suburbs, we're seeing where there's an oversupply of maybe units and high vacancy rate, massive drops in prices. So what we've got is a very different market in different markets, and you just need to do your homework and have a look. And coming to your point then is, well, that might be okay in this particular point in time. What happens now over the next 6, 12, 18 months regarding supply and demand? And one of the biggest things on the horizon is in relation to immigration. Overseas immigration is going to knock off by about 85%. That's a massive hit to the market. It's in demand coming in. However, I spoke to one of Australia's foremost quantity surveyors today, and they're the people that do all the pricing for projects and large developments and residential. And he said his business is down 50%. So what we'll see is in immediate term, an oversupply of stock in certain residential apartments. However, the pipeline is dramatically slowing down as well. So you will actually hit a market equilibrium where supply will also dry up, and that will actually affect will put a floor on prices dropping. So we're going to see certain people in certain areas experiencing some duress and oversupply, but generally we're not going to see massive amounts of stock lying around the market because the pipeline is drying up very quickly. In the medium term, things around land supply, and I remember this happening around the GFC, where a lot of land projects, and land is a lot harder to get to market because the amount of infrastructure that's got to go in place. And when those projects get iced, either by bankers or developers or put on hold, it is harder to get that product to market. So I feel that there's going to be a greater degree, I should say, in shortage in land supply. Now we build homes under the National Disability Insurance Scheme, specialist disability accommodation, and we're looking to buy land, and now we're actually finding it hard to buy land in a number of areas. And we're talking about some semi-regional areas. In Coffs Harbour this month, we had actually put 2 deposits down on blocks of land, Alyssa, and we were gazumped, and they were sold underneath us to someone else. So we actually didn't see an oversupply or pricing power for us to push the price down. We were actually dismayed that we weren't able to secure those blocks. So again, it's different, and to generalize and say that there isn't, there's just, prices will drop by 30%. We just have not seen that in many areas that we've been looking for our clients. In fact, the opposite, they've held fairly firm. And I'm not particularly looking for property in oversupplied apartments, but I've certainly heard and seen valuations dramatically drop on them by banks and also an unwillingness by banks to lend in those areas, and particularly because you're seeing high vacancy rates in those areas.
Okay. So, all right, thanks, Sam. Now, all right. So look, so Sam, many people might be listening and they might have been gearing up to enter the market or prior to the pandemic and now have a level of uncertainty and feeling they should have done this years ago, or maybe they have to wait years until they can invest safely. When is the right time to get into the market? And I might just get you to flick the slides there. Yep, great. Thank you.
Yeah, again, this sort of correlates with the idea of, what's the property market doing? And if I say to you that the right time to buy is any time that you're able to, and if you can do some forensic research and find some opportunities, you can do really well. The reality is, if you have a stable job, and your requirement to build yourself a portfolio to create a passive income has not gone away, and time is ticking, and so you should always look at investing. And if you can do that, there are great opportunities. As that quote said by Einstein, there is value in the market. To also add to that, you've got, and we're going to talk about this shortly, is the cost of funds interest rates are dramatically low. And that really helps you. So if you've got a stable job, now we've seen that, a number of people have been unemployed, but if we look at that as a percentage of the population, we were sitting at about 5% unemployment. Some of the predictions are saying we'll go up to 10% unemployment. That's not an additional 10%, that's an additional 5% on the 5%. So the reality is still 90% of people are working. And those 90% have been advantaged incredibly by having the lowest cost of funds that I know in living memory. And so what that allows people to do is to save a lot of money. A lot of people are at home not spending money, so they're awash with cash. We're seeing a lot of reports showing people are paying off credit cards and debt in a dramatic way. And so that creates an opportunity. So if you can then find properties in the right areas and buy wisely and astutely and get the right returns, it's a great opportunity for you. And I was actually surprised when this all happened. I thought as an organisation, as a business, we would see zero interest over the last, from April onwards. In fact, we've actually seen quite the opposite. We've seen a lot of sophisticated, sensible, well thought out buyers still looking to buy. The actions the government has taken have certainly put a level of confidence to be managed. And what we've also seen is as brand Australia and what Australia's done, we've actually had interest. I've had overseas buyers look to buy in Australia right now because they want stability and they see Australia's managed this really well. And we've exceeded expectations on a number level. Number one, the medical crisis we thought we have, where people were suggesting going to be as bad as Italy, hasn't occurred. Number two, our isolation was talked to be about 6 months. I think it really ended up being about 6 weeks. So for the 1st of June, a lot of restrictions are getting undone. We sort of moved in around about mid-April or early April. So 6 to 8 weeks, it's not as long as predicted. And finally, I think one of the other big things was amazing is the government actually didn't spend as much on its JobKeeper package, so $60 billion shortfall, which gives it a little bit more ammunition to do something later if need be. But so what I'd say to you is, and also I don't think unemployment, it may not actually peak to that amount. And if it does, it will go up and generally come back down. We're already seeing activity out there. There's, I think, record amount being spent on sneakers this past weekend. A lot of users have got this extra cash and they're looking to spend it. So it's not to say people aren't going to be affected, but if there was an advertisement or something put in your letterbox tomorrow by David Jones saying there's a 5% off sale, no one's going to really get that excited about it. So I think 5% of the population affected by unemployment, but there is some good social security cushions that the government's put in there. There's a temporary exposure. The question is, will that continue to be larger? I don't think so. And I believe some of the initiatives being put in place, again, shown by lower interest rates, will very much outweigh some of the increase in unemployment. And those that have the capacity and the ability will do really well. There's also the ability to get maybe a little bit of sharper pricing, maybe a little bit of discount or rebates, but quality holds its own. And what I mean by that is, if you look at the right areas, you'll find that you're not getting massive discounts because the demand is there and the availability of stock isn't as liquid, and the rates there, as I've said to you, in some of the areas that we've been looking to buy land for our SDR homes, there's actually a lot of competition. You think about this, and I think we'll jump in this shortly around the rates. It will help model out why this is a great opportunity to buy.
Yeah.
And I think, I'll leave it for that next question.
Okay. Look, what I wanted to really delve into is a little bit about the interest rates. I mean, we know that we've got some really nice low rates, which is great. Can you just share a little bit, bit more about that, and what does it mean? How hard or easy is it to borrow and actually fund something right now?
Yeah, it's great. So again, I've never, if you told me this, 12 years ago, if you think of the GFC, and I don't know if many people or aware or can remember, just about 12 years ago, 2008, 2009, 11, 12 years ago, interest rates that we went into the GFC as Australia as a nation were sitting between 8 and 9%. Now today, you can get a fixed 2 to 3 year rate for 2.19%, which is a quarter of what rates were just over a decade ago. That is just astonishing. So for the average loan of $500,000, the interest bill is about just over $10,000 a year or $200 a week. So what we're seeing already is that first home buyers or people going, again, if I got a job, this is just the most amazing opportunity for me. You as an investor, if you can get your cost of funds, as we can see here on principal interest at 2.49% on some of the fixed rates, you can also get interest only rates sub 3% as well, 2.79, 2.89 fixed. This is incredible. It virtually has overnight made a lot of properties in Australia, even ones that had poor yields, cash flow positive. And that's why I'm saying this is an amazing opportunity. So once the hysteria dies down, there's a little bit of predictability and some good news. People are going to do their sums and they're going to figure this out.
Sure.
And they're going to come out looking. And just one thing that's really important here, Alyssa, is around residential property. And it's just an interesting anecdote. Frank Lowy, who owned Westfields, sold it about 2 years ago to Rodamalco, a French giant. And he sold the Westfield Group, or his family did their share, of about $34 billion. And recently, the valuation during the crisis hit about 17 billion. So he could have purchased it twice over. I guess all I'm trying to illustrate here is that probably the most resilient property asset class is residential property because it's a necessity. Not everyone needed to be shopping. Not everyone needed to be in an office building. They could work from home. So housing as an asset class generally was probably the most resilient because people needed somewhere to live.
Yeah, sure.
Different types of product will have a different risk exposure.
That's great. Now we've got a lot to get through, Sam, so I'm going to keep you moving along here.
Thank you. You know I can talk a lot.
Good. Interest rates are low, so that's fantastic. When it comes to investing, the selection of property, as we know, is an important factor, and we want to know what types of property should we be looking at or avoiding, for that matter, if you can sort of touch on that briefly, Sam.
Absolutely. So again, I've sort of alluded to a number of times apartments, and what for so many years as I've been doing this, people always told me they would prefer to buy an apartment in the city because they'll get a tenant. Well, guess where's the worst place to have an investment right now? And that is the place closest to the CBD of Sydney. Reason being, most apartment buildings, people might not realise, are generally about 70 to 80% investors that hold those apartments. So when you have something like this where there's a shift in employment and maybe 10% of people are unemployed, and that affects that 70, 80%, that's where you can have a massive swing in the vacancy rate. And that's what we've seen. Then you see massive discounting in the rental market to capture tenants, which then affects property prices. So this has been played out all over Australia's major capital cities or areas where there is high density and high amount of investors. So it's really important that you look at areas where they're mainly owner occupiers and you don't have an oversupply of investor rental stock. Okay,
so for those of you just tuning in, you're listening to Alyssa Dowler. I'm here with Sam Khalil. We're talking about why 2020 is the right time to invest in property. Sam has just been talking about units not so good. What would you suggest as a sensible alternative, Sam?
As I said, Alyssa, it's important to look at areas where the majority of people are owner occupiers, where you've only got probably 10 to 30% at most are rental properties. And you don't have as much transitory populations. So again, some of these areas where you have students and people that are working in certain sectors of tourism and what have you, other areas that are most exposed. So I would be looking for land estates where most people will live in their home, they won't move in their home during a crisis or let go of their home too easily, but people will do whatever they can to keep their home. And so those areas are the ones that you might want to look at. So I'll give you an example, some of the areas that we've had and the type of products that we look at are our dual income properties, and then generally in housing estates where you've got families. And the advantage of these properties is twofold. Number one, you've got a higher rental yield. So even if there was a price adjustment, it still covers you quite well. You've got also 2 tenants instead of 1. The areas have lower vacancy rates and are a little bit more immune to having an oversupply property within those areas. So this, again, has only become better with the lower rates, because a lot of our properties that we have are generating at least 5.5% to 6.5% rental yields. And if your rates are below 3%, you just got a pay rise in your investment property. What we haven't seen, and we manage a number of properties, is any dramatic price drops at all. And we haven't seen any enduring vacancies in these areas. And we manage just over 713 properties, 713 properties.
Right.
So sorry, go on, Alyssa.
So this is a dual income on one title of land, like a house and granny flat.
Yeah.
And how does that compare with, say, a duplex, for example?
Yeah, so other properties that you can look at are duplexes, where you can manufacture some equity. And what I mean by that is that you can buy a block of land of a certain size and actually put 2 separately titled dwellings on it, which you can sell individually. That then, often if you can do well and buy the land at the right price and build a property, by separating the title, you've got 2 properties you can sell, you might see, an increase of some 10 to 20% in the value of those properties. So that again allows you to not only generate 2 rental incomes, but by creating 2 dwellings, you're increasing the value or building a larger share in that for yourself.
Okay, and that looks nice, but maybe if you can talk us through what the numbers exactly look like an example of that, Sam, that would be useful.
Sure. So very good. Here's just 2 areas that we've had recently, and one is Thorney in southwestern Sydney, right on the edge of the Sydney Metro Basin. These packages, you could get land, and land is around that $300,000 mark, which is the entry point. So this is where I don't think you'll see lower price in Sydney. It's way less than $1,000 a square metre. These boxes are about 450 square metres. The rental income that we have achieved in this area is $870 a week, up to about $880, $890. And this is during the peak of the crisis. So that yield is 6.2%. So as I mentioned to you, you can get rates sub 3%. You're manufacturing about $15,000 to $18,000 a year in positive cash flow on this property. Same thing with Canberra. There's a suburb here, a master plan community by Mirvac, which has won an award for one of the nicest master plan communities. And the packages here range between $824,000 to about $840,000. And here we're looking to achieve about $970 a week, a 6.1% yield. Very strong rental demand, very low vacancy rate, and a lot of government employment there, and that's probably one of the reasons for that area. But it's also an estate where a lot of families want to live in, and it's won a number of urban design awards as a result. So this is the sort of product that is far more resilient, isn't exposed to large rental oversupply, generates an incredible yield even during the midst of a crisis. And we haven't had to see any significant discounting, where some of these trendier inner city areas have seen rents being dropped by 20, 30, 40% just to be able to accommodate people for a period of time. So our percentage drop's only been a couple of percent in some areas, which is really marginal when you've seen 20 to 25 or 30% drop in interest rates. So our clientele have actually won with the drop in rates compared to any minor adjustment in rent.
So let's talk about tenants. Now, recently the government announced a 6-month moratorium, giving tenants the ability to request rental reductions if affected financially by COVID-19. Doesn't this add a layer of concern to investors who might buy a great property but they might have
Yeah.
to worry about reduced rent or no tenant at all.
Yeah, look, I lost a bit of sleep over this because in our business we provide rental guarantees, Alyssa. So, and when you're managing just over 700 properties and a significant portion are exposed to that, this could have been a wipeout. However, again, thanks to our leaders in our nation and what they've done, and also, I guess, to our investment strategy and philosophy, we haven't seen that. We just for our existing tenancies, we probably had less than 2% of people exposed in relation to employment. So maybe a dozen people at most. And all of those people rang up and said, I still intend to pay my rent. And no one has actually forfeited or defaulted on their rent. Even one person who was trapped overseas and couldn't get back has done whatever they can to keep their home, which is quite admirable. We may have seen very small adjustments in rents, and some of them are just waivers or deferrals in that. So again, in the type of properties and areas we have not seen massive amounts drop, which has been really good because a lot of our tenants were concerned. There's a lot of things happening in the media. Then comes all the new properties that have just completed, and here we've got some examples of 3 different regions. And again, we had in Fletcher in New South Wales, days on market 6 days, and this is we're talking during the crisis. Horsley down at Wollongong, saying 3 days on market. One of them, again, Thornley, we actually had about 4 or 5 dual keys finish in the area. And all of them were rented within a week. Some when the house weren't even finished, they were leased prior to completion, just like this one here in Thornton. So this, I guess, is a testament to our team, but of property managers, but not only property managers, I guess, to our research team in finding those areas. So where we're seeing, you can see the rental appraisal and the actual amount achieved. And these appraisals, you've got to understand, were done several months, even up to a year prior, where people bought on that appraisal at a different time, and different market, and different environment. To actually achieve results within those bands has been incredible, and again allowed me to sleep very comfortably as well.
I'm glad to hear. Now, in just a moment, we're going to move to some live questions. And just a reminder to everyone tuning in, if you would like to get in touch with our team, you can simply send us an email to hello@dpn.com.au. Now, it's important to note that there are a number of ways that we can assist you. So for first-time investors, we actually offer a personalised strategy service to get you started with a research-based approach. And for those of you with an investment property already, perhaps you're looking to make your next move, we offer a portfolio review service to help you fast-track that. Now, if you've looked at those interest rates and gone, hang on, I want to save some money, our DPN finance team can assist with loans and refinances as well. Now, our business is based on referrals. So if you do know anyone that can benefit from our services, clients, friends or family, we would welcome the opportunity to assist. And these services are complimentary. There are qualifying criteria applying, but drop us an email to get started. Let's move into some questions. Now, we have a question here from Antonio. Antonio asks, is a specialist disability accommodation investment riskier than a duplex or worth the returns?
I think its name gives it away, Alyssa, and thanks, Antonio, is that specialist disability accommodation is quite a special asset class, and it requires you to be an SDA operator. And that's not simply as just a standard investment property. There's a lot of compliance associated with that. And you just need to be aware that it's not just as easy as your average tenancy. You need to be working with providers that would provide the care for the people in the home. It's a much narrower market. The returns can be higher, but the risk is also higher. Also, the lending is treated a lot stricter from the banks because they see it as a riskier and new asset class or investable asset class. So there's a lot of people out there, and we're in a space where we've raised about just over $60 million and rolling out at least 40 homes, and that's growing. We've got a large order book, but it isn't that easy. And what we've seen is a lot of cowboys have seen this opportunity. They've gone onto the government website, seen what amounts the government will pay, and they're touting incredible returns. And there's going to be a lot of tears. There's going to be a lot of white elephants properties built out there without the tenants. And I think people just are being led by greed in that and don't understand that it just isn't that easy. So what I'm saying is, There is a high return, but the risk is considerably higher, and you actually have to overcapitalize the property on the basis to accommodate people that have a disability. And if you don't have those tenants, don't think you can just build it and they'll come. It's a very unique asset class, and that's why they call it specialist disability accommodation. And you have a very small amount of clientele compared to the general property market. So I hope that helps, Antonio, but if you need some more elaboration, happy to unpack that further.
Great, thank you, Sam. Our next question is from Patamar, who asks, what about investment in Canberra?
Again, choose the asset class. So I would say housing in Canberra and certain suburbs will do really well. Canberra is a sensibly sized city, fairly resilient in the sense that it has a lot of government employees. Its culture is growing, lots of great food, hotel and dining and what have you. So I would say it's one of those growing areas in Australia, as in a major city, with resilience built in with the type of demographic that is there.
And we've got time for a couple more questions. I'm going to squeeze in as many as we can in the next sort of couple of minutes here. Manish has asked, what suburbs and states can I get the maximum percentage return?
Okay, so that depends again what you're talking about, capital growth or rental yield. And again, depending on a longer time frame. So I would say to you the main cities that I would consider to be great cities to look over at least a decade are going to be Sydney, Wollongong, Newcastle, ACT Canberra, Melbourne, Geelong associated to that. And again, I'm answering generally.
Yeah, actually, sorry, Sam.
I'd say northern New South Wales. Can you still hear me, or have you lost me?
Yeah, I can hear you. I think Manish has just added to that in the text as well. He's also put in that there are some political tensions. He said, considering the current situation and recession coming soon with political tensions between Australia and China, I don't want to risk by investing more money and looking for, so he's a bit concerned about that, whether that may be a recession or what that means for business.
Sure. So as I said, again, if you think of the type of product you buy and the areas, so we choose areas that are got limited oversupply or strong demand, you'll do well. If you can buy some of these products, they will actually make you money. So I'll give you an example. If you bought one of these dual key investments, they generate $15,000 a year for you. Even if you lost your job, you would now be generating $15,000 a year off your property, which if you didn't invest, you would not have that income coming in. So it's actually a supplementary income. People always ask me if something bad's going to happen. And I said, what do you mean if something bad's going to happen? Something bad always happens. And for the last 2.5 decades I've been doing this, bad things have happened. The question is, will people still live in Australia? Will people have babies? Will the population grow? Will jobs be there? There will be some short-term volatility, but fundamentally, we have seen properties and housing grow in value, and that is just a phenomenon in our modern society, where 50% of the world's population lived in major metropolitan centers by 1997, and by 2050, which might seem a long way away, but it's not that far away anymore. It's only about 30 years away. 75% of the world's population will live in major cities. So if you're buying properties in major cities, you will see population growth, employment growth, scarcity of land, and the price will appreciate. And that's happening whether you're in Mumbai, India, Paris, France, New York, or what have you. Land will run out in those cities, densities will increase, values will appreciate. So I can't talk about what might happen over a 3-month period. If that's what your horizon is for investing, I'd say don't invest in property. But if you're looking at least, if you're going to invest in property, you should have at least a 3-year horizon, understanding that you'll have some short-term volatility in the values. But fundamentally, if you choose the right areas, you'll do really well.
And Josh Bourne has a question, and thanks, Josh, for your question. What are your thoughts, predictions of the Brisbane property market?
Again, that's fairly general. None of us are going to buy all of Brisbane. I would just say which suburbs and just look at the supply-demand equations in those suburbs. So one of the issues is in some areas in Brisbane, you'll find that there's a great ability to provide more stock to the market that will suppress demand. If you look at units in Brisbane CD, it's affected just as badly as units in Sydney CBD. So I would say overall, though, that Brisbane is one of the fastest growing developing cities in the world, as are most Australian cities, that as a percentage, they will grow faster than some of the world's largest cities today. What I mean by that is by percentage. So Mexico City is probably one of the largest cities in the world. It's not going to double in population over a similar time frame that some of our cities will grow, because we've still got a lot of densification to occur. So Brisbane, come down to the suburb, comes down to the product type. I'd be very careful.
Now we're almost about to wrap up here. We've got another final question from Michael. What about Ballina specifically?
Look, Ballina's great. I think anything around that Tweed Coast, what we've seen there is zero price discounting. We've seen scarcity in land. In fact, to the point that the land supply is still, in most instances, over 12 months away. What I mean by that is registered land is not available. The amount of, the area is the Byron region is anti-development. It's a bit like Noosa. There's limited land. They're not allowing high rise or anything like that. So the amount of land that comes to market is very limited. And if you can get some, get it, because anything at the moment that we've been getting some of our clients into has got a long registration period because there isn't just any land available. So also, I just add one more thing, is that it's a little bit of a global place. What I mean by global is a global local place, in that there is a very innovative community, business community there, and people are moving there that are working digitally. They love the lifestyle. You've got actors like Chris Hemsworth building houses at 25 million. There's a brand out of Byron Bay, from food to clothing and what have you. And these people are producing stuff locally and selling it globally. So it's strong brand, strong intellect and people there. And I think it's got a lot of legs. It's also that whole Tweed Coast region from Byron, Ballina, Kingscliff, Tweed Heads, anchors itself, not just as a tourism place, but it anchors itself to the Gold Coast there, to the Gold Coast hospitals, the Gold Coast University and the Gold Coast Airport. So you get the benefits of proximity to a major city without the issues of massive oversupply that you see in the Gold Coast. So if I was going to invest any region, I think you're going to do very, very well in that northern New South Wales region.
So I think that just about brings us to a close. We've run a few minutes over time tonight. It's time to sign off. Now, if we haven't gotten to your question, we will respond to you personally. So apologies if we haven't gotten through everything that you've sent through tonight. Thanks, Sam, so much for your insights. Thank you to our audience for tuning in and spending some time with us this evening. Enjoy the rest of your evening, everybody. And don't forget, drop us a line to hello@dpn.com.au to get in touch. We'd love to hear from you and get your feedback about tonight's session. And that's it from me.
Thanks, Alyssa. I really appreciate you hosting.
No worries.
Thanks, everyone. Talk soon. Cheers.